Right then, good morning, folks, on Thursday, the 10th of August, as we look ahead towards US CPI a little bit later on this afternoon. At 1:30 this afternoon, we do get the latest inflation reading from the United States. Now, it's pretty important as it will decide, or go a long way to deciding, what the Fed's next moves will be. Now, if we look at what is predicted, we are expecting a somewhat sticky reading in terms of inflation. Now, we'll start with the headline figure expected to tick up to 3.3%. You can see consensus here. Now, in terms of the fact that being higher, some market participants are highlighting base effects from the year before, which would suggest that the Fed may not be too concerned about that in terms of the yearly figure. You look at the core CPI print, where you look at 4.8%, the consensus 4.8%. So, inflation is expected to remain sticky. Neither of them expected to push lower over the course of today's reading. But inflation was so high now this time last year that I think it's probably worth more looking at the month-over-month figures. Right, you can see CPI print, the total rate of inflation expected to increase 0.2%. The core CPI expected to increase 0.2% as well. Right, so that is not too bad a reading. In terms of the Fed's preferred kind of targeted percentage, of inflation, around 2% a year. So still is slightly above that, but it is a more manageable rate of inflation, obviously, than it has been previously. These prints up at 0.5% and things like that are not good for inflation continuing. But if we have a look at the inflation print in terms of the monthly figures, we've obviously had a few outliers in recent months where we see 0.5 in January, 0.4 in February, 0.4 in April, mixed in with a couple of 0.1 and 0.2s over the course of the last 6 or 8 months as well. If we have a look back to the core CPI print in terms of the month over month, that is a little bit higher. It was extremely low last month, but before that, 0.4, 0.4, 0.38, 0.45, that is still far too high in terms of the core CPI print. So both of these expected at 0.2%. Inflation in terms of the yearly figures not expected to come back down, which is still a bit tricky. So there is some concerns about this, about it being 3.3%. Now, some market participants believe that the Fed will not be too worried about that, but in my opinion, that is not a good sign in terms of fully getting inflation under control. And then you got to think to yourself, what are the tradable opportunities, right? So, in terms of tradable opportunities, in terms of what the Fed will want, they will want a lower than anticipated print. They will want inflation to get under control and to not have to hike interest rates at their September meetings, right? What markets have currently priced in is for no hike at the September meetings. And then you got to think, where's the pain? Where does the pain come from? The pain comes from a higher than anticipated CPI print. If the monthly figures come in higher than anticipated, well, then naturally you'd expect all these to come in higher than anticipated. So in terms of pricing at the next interest rate decision, you can see target rate probabilities for the next meeting: 86.5% chance of no change, and then a 13.5% chance of another 25 basis points worth of hikes. So if you do get a higher than anticipated inflation reading, that does go in line with strong GDP figures, strong manufacturing figures in the form of durable goods orders. We had pretty mixed jobs figures last week. NFP was slightly lower, but what we had was the unemployment rate ticking down and wage growth remaining strong. They are all contributing factors to inflation and all reasons that the Fed can continue to hike interest rates if necessary. Now, none of that is priced in for them to hike interest rates at the next meeting. So the ideal situation from a tradable opportunities perspective is in my opinion, is for a move or a higher than anticipated print in CPI today. Now, you have to see, you look at that and there's 86.5% chance of no hike. Even if that comes down to 70 odd off the back of a higher than anticipated print, that should cause substantial moves in markets, right? And you got to look across the assets at what is up, what is down. You can see recent price action across stock indexes range bound, which is to be expected in the lead up to ECB. I was going to say it's expected in the lead up to those CPI prints, but after that jobs data last week, markets have not really got any sort of traction in either way. They've been up, they've been down, they've been up, they've been down. We were looking at earlier on in the week. We were looking at Monday at selling the highs, buying the lows, which has proved pretty fruitful if you could kind of get involved in them, but hasn't quite done enough to reach resistance levels, or kind of barely broken through support. So a little bit difficult to trade over the course of the week. Certainly across the S&P. The Nasdaq and the Russell with a downside, but clear range bound on the Dow Jones over the course of this week. So there's no sort of build up of positions in the lead up to this CPI print. Markets a bit range bound, and obviously the US stock indexes are in focus as we head on into today. So range bound across US stock indexes. You look at the US dollar, pretty range bound. Apart from dollar yen pushes higher due to higher energy costs. Prices of energy. Oil, for example. The Japanese have to import a lot of oil, so the price of oil pushing higher is negative for the Japanese yen. That's the kind of reason they've put down to that. But that's more Japanese yen move than it is a US dollar. There's been a bit of selling of the US dollar in today's trading session, but there was buying of the US dollar on Tuesday. So we are still trapped in recent ranges. You can see the Aussie, Kiwi, Euro, Sterling all range bound. You can see dollar Swiss range bound. Dollar CAD was up and then back down, pretty range bound, as well as the US dollar index. So not a lot of clear direction across the US dollar, across equities. Into yields, you can see yields over the course of this week not too positive by any stretch of the imagination. You had that Moody's downgrade on a number of US banks, which caused some downside in yields earlier on in the week. You had the NFP print last week, which did cause some downside in yields as well. Apart from that, you have just ranged sideways over the course of this week, and that is a little bit tricky obviously to trade, but markets clearly lie in wait for that CPI print a little bit later on this afternoon. Now, if we get higher than anticipated prints, right, so above consensus on the majority of these prints, that will be long dollars, short stocks, and short bonds, which would be yields higher, right? If we get it on the flip side, if we look towards lower than anticipated inflation prints, that would be short dollars, that would be long stocks and long bonds, which would be short yields. That would be the expected reaction to these type of prints. If it comes in line with consensus, it means it's a little bit more of a difficult trade. I think probably stocks grind higher a bit off the back of that, as it's no upward surprise to inflation. So that's probably how I would choose to view it. In terms of gold's maybe a slightly difficult trade, as it can be seen as a hedge against inflation. If inflation rises, it's positive for the dollar, but gold can rise off the back of that as well. So maybe gold a little bit of a difficult one to trade today, but they're the kind of expected reactions to each of these scenarios. Where it gets a little bit tricky is probably the in line with consensus print, but surely the pain trade with the way markets are priced for that September meeting, with strong economic data recently out of the US. Surely the pain trade is on a higher CPI, and that is where the biggest move will come from. Does it materialize? The chances of that happen are less than 50-50. I mean, the chances of it being lower than anticipated or in line with consensus is a lot more. But on the off chance that we do get higher than anticipated CPI prints, that will probably solidify an interest rate hike on the 20th of September. And that is not currently priced in by markets. So that's personally what I'll be hoping for. Any beat on inflation, that is what I'll be trading. If it's a miss on inflation, you probably look to take a position in line. Maybe a little bit tricky, but certainly higher than anticipated inflation print. That is where the pain trade is. And if that happens, it should open up some good tradable opportunities.